Three billionaires went on record this week calling crypto worthless. And Bitcoin just broke below a technical level it has only touched 4 times in its entire 15-year history. The last 3 times this happened, half the market declared it dead. What came next is the thing nobody talking about the sell-off wants you to know. Bitcoin just closed a weekly candle below the 200-week moving average. Let that sink in for a second. That single line on a chart has been the ultimate long-term floor for Bitcoin through every major crash in its history. The 2018 bear market, the COVID collapse, the FTX implosion. Every single time price dipped below it, buyers showed up. Every single time it held. Until now. We are talking about a level that has defended roughly $3 trillion in total crypto market value at its peak. And right now it has cracked. Social media is flooded with people calling this the end, the death of the cycle, the confirmation that this time really is different. And look, I get it. The fear is real. The charts look ugly. But here's the thing that nobody screaming in your timeline is stopping to ask. Have we actually seen this movie before? Because the data tells a very specific story, and it is not the one most people are reading right now. Let's break it down. So let's actually break down what hit the market this week, because it wasn't one thing. It was 4 things landing almost simultaneously. First, the Clarity Act, which was supposed to give crypto its long-awaited regulatory framework in the U.S., stalled out in committee. No vote, no timeline, just silence. Markets hate uncertainty, and that silence was loud. Second, headlines started circulating about Trump's proposed crypto bank initiative, and the corruption angle spread fast. Journalists and politicians piling on before a single detail was confirmed. Third, Binance quietly pulled back from several key European and Asian markets after fresh regulatory pressure, which rattled confidence in centralized exchange liquidity. And fourth, and this one gets underestimated, the Fed's rate cut timeline got pushed out again. When money stays expensive, risk assets suffer, and Bitcoin is still considered a risk asset by the institutions that move real volume. Each of these stories alone would barely register. Together, they hit sentiment like a freight train. But here's the thing. Noise and signal are not the same thing, and most of the commentary this week confuse the two. What the on-chain data is actually showing tells a very different story. So let's talk about the names attached to this sell-off narrative. Jeremy Grantham, legendary value investor, genuinely brilliant on equity bubbles, has been calling Bitcoin a speculative mania for years. And look, the man's track record in traditional markets is real. But his track record, specifically on crypto, he's been wrong on the timing so many times that if you'd shorted Bitcoin every time he issued a warning, you'd have been wiped out multiple times over. That's not an insult. It's just a different asset class, governed by different mechanics. Here's the part that should make you stop and think. In the same week these bearish headlines were running wall-to-wall, spot Bitcoin ETFs in the U.S. recorded net positive inflows. Not outflows, inflows. BlackRock's IBIT alone absorbed hundreds of millions of dollars in new capital during that window. So somebody is on the other side of every single one of these fear-driven retail exits. And it's not a random someone. This is the gap between public narrative and private order flow. The story in the headlines and the story on the books are not the same story. And once you understand that, you start reading the on-chain data very differently. Here is where most people completely lose their edge. They stop at the headlines. So let's cut straight to the chain. First, exchange outflows. Right now, Bitcoin is moving off centralized exchanges, not onto them. When coins flow to exchanges, that is sell pressure building. When they flow off, that is accumulation, people pulling Bitcoin into self-custody because they have no intention of selling it soon. Net outflows have been consistent over the past several weeks, even as the price slid. That divergence is meaningful. Second, look at long-term holder behavior. These are wallets that have been sitting on Bitcoin since the 2018 bear market lows and the March 2020 crash. The cohort that has seen every cycle, every panic headline, every wave of obituaries written for this asset. They are not moving. Spending activity from that group remains historically low. They have been through worse, and they are not flinching now. Third, the MVRV Z-score. This metric compares Bitcoin's market cap to its realized cap, essentially what the market values Bitcoin versus what people actually paid for on average. Right now, that score sits in the blue zone. Historically, the blue zone is where the long-term buyers were right and the panic sellers were wrong. Every single cycle. And what about the political wild card sitting right on top of all of this? Now let's talk about the political side, because you can't ignore it right now, even if you want to. The headlines about Trump and crypto banking sound wild, and honestly some of them are. But underneath the noise, there is something genuinely important happening in Washington that most people are sleeping on. The Clarity Act is the piece of legislation you actually need to understand. What it proposes, in plain terms, is a cleaner line between the SEC and the CFTC over which of them has jurisdiction over digital assets. That sounds boring. It is not boring. Right now, every serious crypto project in the United States operates under legal ambiguity that makes institutional capital deeply nervous. You cannot build a compliant product when two regulators are fighting over who owns the rulebook. And here is the competitive pressure that makes this urgent. The European Union already passed MiCA. It is live. It is imperfect, but it exists, and businesses are already building around it. The U.S. is in a race it does not fully realize it is in. Here is the contrarian red, though. Washington's dysfunction might actually speed things up. When both parties want to claim a crypto win before midterms, gridlock becomes unlikely. Historically, every time regulatory clarity has arrived, even partial clarity, price responded. Which brings us to the angle almost nobody in this space is talking about right now. Here is the thing that every headline is missing right now. In the three prior instances where Bitcoin closed below the 200-week moving average, it was within weeks of an absolute generational low. Every single time. In January 2015, Bitcoin was trading around $200 when it undercut that line. The bottom came at $150. And within 18 months, the price was above $500. In December 2018, the 200-week gave way near 3,200. The actual floor hit at 3,100, essentially the same candle. In March 2020, during the COVID crash, Bitcoin briefly sliced below that average near $5,000. It bounced within 2 weeks and never looked back. 3 cycles. 3 times that line broke. 3 generational buying opportunities followed. Now, I'm not saying the 4th time is guaranteed to rhyme. Markets evolve, institutional players are bigger, macro conditions are genuinely different. The 4th time could absolutely break that pattern. But a 3-for-3 track record across a decade demands respect, not dismissal. The one thing that confirmed each of those lows was capitulation volume, a massive, panic-driven spike in selling that exhausted the sellers completely. That signal is the one thing worth watching right now, and we're going to break down exactly what to look for. But here is where I owe you some intellectual honesty. Because if I only tell you the bull case, I'm just another guy on the internet telling you what you want to hear. So let's actually steelman the selling. First, the halving. Yes, it reduces supply, but each cycle, the absolute number of coins removed from daily issuance gets smaller. We went from 1,800 new Bitcoin per day to 900, now to 450. The supply shock is shrinking in real terms. The math still works, but it hits softer every 4 years. Second, ETF inflows have plateaued. And ETF redemptions are not like a retail panic sell. They are structured, institutional, and they hit the market systematically. That is a mechanism we genuinely have no historical playbook for. Third, and this one keeps me up at night, a real global recession. In 2022, crypto did not act like digital gold. It acted like a leveraged tech stock. If credit markets seize up and risk assets sell across the board, there may simply be no safe haven bid to catch Bitcoin on the way down. These risks are real. Anyone dismissing them is selling you something. What matters is what the data is actually signaling right now. So let's talk about you specifically. The person watching this with a portfolio that's down, maybe significantly, and that uncomfortable itch to just do something. That feeling is real. It's wired into us. But here's the thing. The urge to act during a drawdown is almost always the market's way of shaking you out at exactly the wrong moment. Think about two people who both bought Bitcoin in early 2018 near the peak. Person A watched it drop 80%, panicked by December, sold, and told themselves they'd buy back when things felt safer. Things never felt safe enough. They missed the entire 2020 and 2021 run. Person B held, kept buying small amounts every month through the silence and the doubt. And by mid-2020, they were not just recovered, they were ahead. That's not a made-up story. That's documented investor behavior playing out over and over across every asset class that ever existed. Markets don't reward certainty. Certainty never comes. They reward patience and consistency when everyone else is making decisions with their stomach instead of their head. And that brings us to the one signal you actually want to be watching right now. So here is the one thing to have on your screen every Sunday night. Watch where Bitcoin closes on the weekly candle relative to the 200-week moving average. Right now, that average sits around $38,000. As long as weekly closes hold above it, the macro structure is intact. The moment you see two consecutive weekly closes beneath it, the bear case I outlined becomes a real conversation. Pair that with exchange net flows. If coins start moving back onto Coinbase and Binance in size, that is distribution, not accumulation. Those two signals together tell you more than any pundit ever will. On the macro calendar, the Fed minutes drop mid-July, and the next congressional crypto hearing is shaping up for late summer. A dovish Fed red, combined with outflows from exchanges, would be genuinely bullish. A hawkish surprise with coins flooding back onto exchanges. That is when you want to be cautious. These signals move fast, sometimes overnight. If you want to be in a room when something breaks either direction, subscribe now, because that video is coming the moment it does.